The big oil deal with OPEC Plus is done. The Organization of the Petroleum Exporting Countries and its allies on Sunday have agreed to a record cut in output to prop up oil prices amid the coronavirus pandemic. The unprecedented deal with oil nations, including the United States of America, has been signed to curb global oil supply by 20%. Coronavirus-led travel bans across the world have destroyed demand for fuel and have driven down oil prices, straining the budgets of oil producers and hammering the US shale industry, which is more vulnerable to low prices due to its higher costs. Now, prices were further getting impacted by Saudi Arabia and Russia feud, as none of these countries were earlier getting ready to slash production. The group, known as OPEC Plus, has now agreed to reduce output by 9.7 million barrels per day for May and June. And this is the biggest oil cut ever and is more than 4 times deeper than the previous record cut in 2008. Producers will slowly relax curbs after June, although reductions in productions will stay in place until April 2022. Total global cuts will include contributions from non-members and also steeper voluntary cuts by some OPEC Plus members and strategic stock purchases by the world's largest consumers. Saudi Arabia, the UAE and Kuwait would actually cut supply steeper given the higher output in the month of April. Non-members such as Brazil, Canada, Indonesia, Norway and United States would contribute 4 million to 5 million barrels per day. OPEC Plus initially had proposed cutting production by 10 million barrels per day on April 9th. But Mexico was opposed as it was worried about derailing its plans to revive its heavily indebted state oil company, Pemex, and therefore was unwilling to cut the asked amount. Now, despite the record size of the cut, some fear that it is still not large enough to combat the drop-off in demand in oil. Now, experts say that this is at least a temporary relief for the energy industry and for the global economy as this postpones the stock building constraints problem. The worst is for now avoided. So what does this really mean for the oil markets really? Well, oil prices had slumped in March to an 18-year low after OPEC Plus had failed to agree on the cuts. These cuts are though historic, market reaction to them has not been very enthusiastic. Brent crude prices rose about 5% today and traded at over $32 per barrel. The gains seem to be capped for right now because of a number of reasons. Let's go through them one by one. 1. Some markets are still shut on account of Easter Monday. Secondly, calculations are still on as to how much will this cut really have an impact. Remember, the demand destruction has been quite substantial because of all these reasons cited earlier. Thirdly, these output cuts will be in effect from May 1st, and in the meanwhile, oil experts say that one is looking at 1 billion barrels of inventory being generated, putting additional pressure on the prices. Experts also say it will be only until the second half of the year when prices and demand will recover and may return to normal.